Warren Buffett is hoarding $300 billion. Here's what he knows that you don't. Imagine having $300 billion. Not 1,000, not a million, 300 billion. And instead of investing it, buying companies, building an empire, you just sit on it in cash. You buy nothing. You just wait. That's exactly what Warren Buffett, the most successful investor of the last 100 years, is doing right now. To really grasp the size of that number, let's put it in perspective. $300 billion is more than the entire yearly economic output of a whole country, Finland. It's roughly equal to Apple's entire annual revenue, one of the biggest companies on the planet. And it's more cash than Apple, Amazon, Google, and Microsoft are holding on their books, combined, for massive corporations at once. And one single man controls all of it. If you tried counting that money out loud, $1 per second, without stopping to sleep or eat, it would take you close to 9,500 years. Here's the part that matters most. This isn't an accident, and it's not a mistake. It's a deliberate decision. Over the last 3 years, Buffett sold off nearly $170 billion in stocks and bought back very little in return. He walked away from position after position on purpose. So the real question is this: why would the greatest investor in history refuse to invest his own money right now? What does he see that everyone else doesn't? Today we're breaking down 5 reasons, and more importantly, showing you how to apply that exact same mindset to your own money, even if you've got $300 instead of $300 billion. Reason 1. He sells his winners once the price runs past the real value. This year, Buffett cut Berkshire's position in Apple by more than 60%, selling off around $100 billion worth of a company he once called the best business he'd ever seen in his entire career. And he still sold the majority of it. He did the exact same thing with Bank of America and Chevron, gradually walking away, position by position, from assets that had already made him enormous profits. It's not that these companies suddenly became bad businesses. It's that their price ran far ahead of their actual value. A stock can be a wonderful business and still be overpriced by the market at the same time, and that's exactly the moment a disciplined investor locks in the gains instead of doubling down. Most people do the exact opposite. They fall in love with something that's already made them money and hold on far too long, because letting go of something that keeps going up feels emotionally impossible. Buffett has spent 6 decades training himself to do the opposite. Reason 2, he doesn't buy what everyone else is buying. For most of last year, Buffett was a consistent net seller of stocks, not out of fear of crash. In his own words, he was struggling to find investments offering a fair return for the risk involved. The broader market, judging by how expensive stock prices were relative to company profits, was sitting at historically elevated levels. Here's the lesson: just because everyone around you is buying something doesn't make it a smart purchase. When a price has run far ahead of the real underlying value, buying at the very top isn't investing anymore. It's betting that someone else will pay even more for the same thing later. Most people do the opposite instinctively. They watch the price climb every single day, feel like they're missing out, and buy right at the very top, purely out of the fear of being left behind. Buffett has spent years training himself to do the uncomfortable thing instead, stepping back exactly when everyone else is rushing in. Reason 3. Patience is the actual strategy, not a side effect of it. A lot of people assume Buffett is holding cash because he's predicting an imminent crash. That's not quite accurate, and the distinction matters. Buffett has repeated the same idea for decades. Nobody, including him, can predict what the market will do next month or even next year. What he can do is wait, sometimes for years, until a genuinely attractive opportunity finally shows up, something he's referred to in the past as waiting for the perfect pitch. Picture a baseball hitter who doesn't have to swing at every single pitch thrown his way. He can let 100 average pitches go right by, and wait patiently for the one perfect pitch to put everything into. That's exactly how Buffett approaches money. This is the third lesson, and it might be the hardest one to actually put into practice. Deliberately doing nothing while everyone around you is doing something requires a level of discipline most people simply don't have. Reason 4. Cash isn't dead money, it's a loaded weapon. This is where most people get it completely backwards. They see a huge cash balance sitting in an account and assume it's wasted potential, money that should be out there working somewhere else. Buffett sees it the exact opposite way. Historically, he's built up cash during periods when the market looked overheated, and then deployed that same cash aggressively during periods when everyone else panicked and prices collapsed. Back in 2008, during the financial crisis, while most investors were terrified and selling everything they owned, Buffett was one of the few people with enough cash on hand to buy stakes in major companies at steep discounts, entirely on his own terms. That's the real purpose behind these $300 billion. They're not sitting there because Buffett ran out of ideas. They're sitting there so that the moment fear takes over the market and prices fall hard, he's one of the only buyers left standing with the resources to actually act. Reason 5. Even a legend admits the timing is never perfect. It's worth saying this honestly. Buffett has openly admitted his own timing isn't perfect. He said he's been early before on both the buying side and the selling side. Holding cash for years means accepting that you'll miss out on some further gains while you wait. And this is probably the lesson that trips up almost everyone who tries to copy this approach. Patience always looks like a mistake right up until the exact moment it looks brilliant. Anyone holding cash while the market keeps climbing will, for a while, feel like they're losing. The discipline is in staying the course anyway, precisely when it feels like you're falling behind. Now, picture an ordinary guy. Let's call him David. Not a billionaire, just a regular person with a savings account and a trading app on his phone. For years, David did exactly what most people do. Whenever he had extra money, he threw it straight into whatever was trending that week because it felt exciting. Every time the market dipped, he panicked and sold. Every time it spiked, he bought right at the very top, chasing the hype. Then David started applying these same 5 principles, just on a tiny scale. First, he stopped holding on to investments purely out of emotional attachment, the same way Buffett let go of a huge chunk of his Apple position. Second, he stopped buying something just because the price was already climbing fast and started asking whether that price actually made sense. Third, he built the patience to let real opportunities come to him instead of chasing every headline. Fourth, he started deliberately keeping part of his savings in cash, specifically so that when prices eventually dropped, he'd have money ready to act instead of being forced to sell something else at a bad time. And fifth, he made peace with the fact that some months, the cash would just sit there doing seemingly nothing. A year later, David wasn't suddenly rich, but he also hadn't panic sold during a rough stretch because he had cash set aside instead of everything locked into investments. And when a real opportunity finally showed up, he actually had the money to take advantage of it, something most people around him didn't have because their cash was already spent chasing the last trend. That's the entire lesson wrapped into one story. It was never really about the $300 billion. It's about the decision-making process underneath it. Let's bring all 5 reasons together. 1. Be willing to sell your winners once the price runs far ahead of the real value. 2. Don't buy something just because everyone else is buying it. 3. Patience isn't weakness, it's the actual strategy. 4. Cash isn't dead money. It's ammunition for the moment a real opportunity finally shows up. And 5. Even the best investor in history admits his timing is never perfect. And that's fine because discipline matters more than precision. None of these 5 ideas require $300 billion to apply. They require patience and the willingness to feel a little uncomfortable while everyone around you chases the next big thing. If this video changed how you think about money, leave a comment and tell me, are you someone who chases every trend, or are you willing to sit on cash and wait for your moment? Subscribe, because next up we're breaking down exactly how the richest people on the planet actually think about money.